Rob's Child here. Nothing I say is investment advice. I can double my money using Treasury Bonds? What? That's right. If you're unfamiliar with TLT, the most popular Treasury bond fund in the world, take a look at the chart. Or even better yet, ZROZ, which holds the same assets but has a longer duration and zero coupon, which actually makes it go higher when interest rates go down than TLT does. So let's get the risk out of the way first. So where is the risk here? The risk is if inflation continues to be a concern, if it continues to become more worrisome than it is already, then these bond funds can lose some value, at least temporarily. If inflation continues to get worse, they will continue to get cheaper. Along with this, mortgage rates will be higher. So if you can imagine in 5 years from now, 10 years from now, mortgage rates will be 15%, 20%, they'll just keep going up, then you really should not invest anything into TLT or ZROZ. But if you can imagine rates going back down, mortgage rates being, let's say, 5%, 3%, even lower than that, then this is a perfect place to invest some money. So let's go over the reasons that this reward for this risk looks attractive to me. So first item is debt affordability. The United States, when they sell these treasury bonds, they have to pay them off. How do they get that money? They get it through taxes. They have to collect taxes to pay that off. The other way is when the Federal Reserve is quantitatively easing and purchasing massive amounts of bonds. Those are the two ways of sort of decreasing the debt that the United States has and decreases the amount of the payments that they have to make on a yearly basis. Second point, so first was debt affordability. Number 2, dependence on tech for U.S. GDP. The United States always has been, and may always continue, and may always be, or at least continue to be for a long time, the tech place of the world. We have the people, we have the right structure of government and capital structure in order for that to work. And when you have high rates, it makes the development of tech less affordable. It becomes harder to make money on new technology. Along with that, the technology that ends up being used is deflationary itself. No longer do we need 90% of people to be farmers, or 95%, whatever it used to be. In the future, we will no longer need the large percentage of workers that currently drive trucks around the nation. They will be driving themselves, just as one small example. Fast food restaurants. We already have fast food restaurants that are they exist anyway, that are entirely run by robots and AI. We need more technology in order to continue making ourselves in the United States and the whole world a wealthier place. And in order to do that, rates can't keep going up. They can't keep being too high in order to afford to be able to invest in the increasing and production of new technology. Number 3, we don't have super high demand in the United States. Birth rates are not very high. The 1970s inflation was driven because of the baby boomers all trying to buy houses and buy all the same things all at the same time. There wasn't enough stuff, so money had to become more expensive in order for inflation to be guided lower. We're not in that situation right now, and so I see that as more reason to be looking at the reward that Treasury bonds can give you more than there being a risk in that area. If Treasury bond rates, the 30-year bond, goes below 4% at any time within the next 15 to 30 years, if you were to buy the bond today, that bond will be in its capital value higher. It will go up in value if rates go down, especially below that 4% marker. So if you can easily imagine that, as I can, then that is a good reason to also be buying Treasury bonds and Treasury bond funds. Now, maybe people might think, well, rates might get a little higher, or they might be much higher in 5 years from now and stay higher for longer than I'm comfortable with. Well, then maybe buying less bonds would be a good move for you. Maybe not buying them at all might be a good move for you. But 4% rate of return for a 30-year bond is above the current Fed target inflation rate of 2%. If we achieve the Fed, and remember, don't fight the Fed, if we achieve a 2% inflation rate over time like they want it, by the way, it being high makes me think they'll accept a lower than 2% rate for some time moving forward, then that 4%, you're getting a real return on top of the inflation rate that the Fed is targeting. And to me, that's a good deal. And then, I think this is the fourth or fifth point, comparing it to the risk in other assets. Gold, $2,000 an ounce. Inflation gets worse. Gold can get to a higher price. Yes, it can. Will it? I don't know. I think personally it can equally get back down to $400, maybe even below that. It wasn't that long ago where gold was $200 an ounce, historically thinking. How about compared to silver or other more industrial metals? Severe downturns, if you look through history, silver usually loses its value to the dollar. Can it go up in price? It can. Is the risk worth the reward? Potentially. I actually have a little bit of silver exposure, but not as much as I have of bonds right now. And what about comparing it to the valuation of equities? Well, just recently, earnings compared to the value of stocks right now for the whole S&P 500 is currently below the return that you can get from treasuries. This oftentimes signals a major market sell-off in equities in order to make the math work out a little bit better. After all, who wants to own a company that's only able to earn, say, 2% of its stock value in its earnings when you can buy a treasury bond that is giving you over a 4% return guaranteed for the next 30 years? The math doesn't work out, friends. Either earnings have to go way, way up, or treasury yields need to go down. You can't have what we currently have right now. something's going to change. And I believe that change is going to be lower rates on Treasury bonds. If we get to a point where we have a major financial crisis, this is the last point I want to make, there's many ways to hedge your portfolio. You can invest in an inverse fund. You can buy put contracts which expire. Those have their benefits. They have their risks involved. Options expire. You can invest in the volatility index in various ways. You can buy call contracts on UVXY or UVIX. You can buy those funds directly, get some easy, accessible VIX exposure to it directly. Of course, those, for me, have higher risk compared to the potential reward you can get in a equity crash. Ironically, earnings of companies compared to their share price skyrocket. However, and Treasury bonds tend to collapse. And ironically, that's when stocks become more valuable. And Treasury bonds, relatively speaking, become less valuable. However, the prices go way up on Treasury bonds and way down on stocks. And that's where I want to be, especially if there's another major financial crisis, which seems inevitable at this point moving forward. But that's just me. Again, none of this is investment advice. I hope you enjoyed this episode of discussing Treasury bonds. Rob's Child.